Hi and assalamualaikum and a very good morning to madam. I'm from Team Dragon, which is consists of 4 members, which is myself is Muhammad Nabi Jafar, Zari Irfan, Afiq Faruqi and Hazmi. So this is our last video for VR4, which is synthetic option. So let's dive in. Regarding from the question, this is a bear put spread strategy. The traders sell a 10 ringgit put option for a premium of 50 cent and simultaneously buy a 11 ringgit put option for a premium of 80 cent. This strategy is typically used when the trader expects the stock price to decrease moderately. The reason for this strategy is to limit the potential losses while the still profiting from the declining in the stock price. The premium from selling the 10 ringgit put partially offset the cost of buying the 11 ringgit put, reducing the net expenses.
Hello, so let's break down a short put strategy using specific parameters and calculations. So the strategy overview is we are analyzing a short put with an exercise price of 10 ringgit and a premium of 50 cent. This strategy involves selling a put option to gain premium income, but it carries the risk of limited losses if the underlying price drops. So the parameters is short put is 10 ringgit and the long put is 11 ringgit. And the net premium paid is 80 cent minus with 50 cent and we get 30 cent. So this reflects the cost after subtracting the short put premium from the long put premium. So for profit and loss analysis, the maximum profit occurs when the underlying price stays above the short put strike price, where the profit is 70 cent, and the maximum loss happens if the price falls significantly. The calculated loss is limited to 30 cent. So the break-even point for this strategy is where there is no profit or loss, which is the BEP is 11 minus with 30 cent equal to 10 ringgit point 7 cent. So this means if the underlying settles at 10 ringgit and 70 cent, the position neither gains nor loss. So for the payoff profile, if the underlying price is less than the short put, so the profit is kept at limited profit, and if S is greater than the long put, loss is kept at limited loss.
And for lastly, I will explain about the diagram. So this diagram appears to represent the profit and loss graph of an options trading strategy. So here's a breakdown of each component. First of all is the axis. So the vertical axis, profit or loss, represent the amount of profit or loss in the trade. So the horizontal axis, which is S, represent the price of the underlying asset. Second is the region. So we have 3 regions: in the money, at the money and out the money. So first of all is in the money, which is ITM. When the underlying asset price is below 10 on the left, so the position is profitable, shown by a positive value 0.70 on the profit axis. Second one is at the money, which is ATM. So when the underlying asset price equals to 10.70, there is no profit or loss, which is profit or loss equal to 0. And last one is out the money, which is OTM. So when the underlying asset price exceeds 11 on the right, so the position incur a loss, shown by a negative value, negative 0.30. And the key point here is the 10, which is a critical point, likely representing a strike price where the option starts transitioning into profitability. And second one is 10.70, the break-even price, where there is no profit or loss. And the last one is 11, the point where the maximum loss occurred, indicating the trade becomes completely out of the money. And possible strategy, the diagram could represent a bear put spread where a trader buy a put option at a higher strike price and sell a put option at a lower strike price, and a similar option is a Miller option strategy that limits both profit and loss within a specific price range.